The market opens up, does its circus act, and runs right up into an inversion fair value gap on the 15-minute time frame. You know this gap because of what I was covering so far this week. It just reversed its role because we were below it, came up, hit it as an inversion fair value gap. That's probably random, and then trades lower. And then one more time, we drive right back up into the lower quadrant of this gap, which is the wick. So I'll counsel you to think about that right there, measuring that on your fib. Don't trust my charts or my commentary alone. The market rolls over and creates this inefficiency on the 15-minute time frame. But you notice that it doesn't look the same as it did on the 15-minute time frame, because it looks like we opened here, traded down, then opened here, went down a little bit, and then opened here and went down. So how's that an inefficiency here? Wouldn't it just be this portion as the inefficiency? Well, on the 5-minute chart it is, but we're looking at it from a price delivery continuum. Okay, so what I constantly do is I'm going through time frames. Every single time that we close 1 full hour trading, at the top of every 60 minutes, I'm referring back to the hourly chart. I want to get a feel for where we're at. Was there any inefficiencies? Is it respecting any inefficiencies? Is it aiming for buy side or sell side that is on that time frame? I'm not living on the 60-minute chart. I'm just referring to it at the top of the hour every single time we get a new hour start. Every 15-minute time frame, the same thing. Every single time we close a 15-minute interval, I'm going back to the 15-minute time frame and I'm cycling through that information that's on that chart. And imagine what we just did showed the 15-minute time frame and then dropping back from the 15 down to the 5-minute chart. Every 5 minutes, I'm going back to the 5-minute chart. I'm only looking at it until we get a new 5-minute close. So when a candlestick on the 5-minute time frame closes and a new one begins, I'm going back to that 5-minute chart and referring back to it. Now, when you see me doing my trade examples, many times it's just me showing you on a 1-minute chart, but I'm telling you what I'm doing. I'm cycling through the time frames just like that. So that is my price delivery continuum theory. It means I'm constantly cycling through all those time frames. It's not top-down analysis. It's cycling through continuously looking for algorithmic PD arrays where a price is going to respect to a degree and then maybe fail, and that gives me information. I'm constantly feeding my attention with these things that are on these specific time frames, and I'm not living on those time frames because all I have to do is refer to it real quick and see where I'm at and then go right back to that 1-minute chart. Here, this little area here is that 15-minute time frame fair value gap, or SIBI. But it looks different because it takes up what? It takes 3 of these candlesticks to make that one 15-minute candle. So let's get some detail here. So we're going to, again, use the high of that fair value gap. So I'm darkening it up here. And then this one here, that's your range. Inside of that range, we're going to be studying with a lot more detail. With both of these levels now understood that that's the 15-minute time frames high and low of its fair value gap, or SIBI, look over here on the 1-minute chart. So we watched at the beginning of the discussion on pound dollar, I showed you the 15-minute time frame and the very specific fair value gap. Then on the 5-minute chart, and then now that same gap being viewed on a 1-minute chart. So right away, you see this inefficiency, you see this inefficiency. So what do you do? What do you do with that information, Michael? How do you navigate that? Well, you certainly don't go to level 2, and you certainly don't need to pull up a footprint. You don't need to do anything with DOMs, VWAP, all those things. I promise you, none of that stuff is necessary. Everything you see here as it relates to time and the open, high, low, and close. That's all you need, folks. I promise you. If you know where the market is likely to go, that's the bias, the draw, and liquidity. If you know that, open, high, low, and close, and the time of the day or the session is all that you need. I promise you, I'm going to prove it to you today. So what we have here is this shaded area from this candlestick's low and this candlestick's high. That is the basis of that 15-minute fair value gap. But it's being shown on a 5-minute chart here. So if we look at that same range on the 1-minute chart, there's some characteristics in here that I want you to notice. Now, I've spoken on this before, but I kind of like want to bring everything together and synergize everything so that way you can see how the algorithm fires off and refers back to these price points. When I first started teaching, I would look at the charts and I'd say, all right, now my students are going to want to be looking for something that reoccurs. So I started by labeling things as points of interest, okay? And now everybody refers to them in their own little mentorships as POIs or something to that effect. But it all comes from my mentorship level lessons and stuff. When we refer to a point of interest, the point of interest that's most important when we're looking at a fair value gap is when we're looking at a bearish fair value gap, we want to study the upper half of it first. Because the upper half of that fair value gap, when it's bearish, is going to tell you a great deal of information. And when you're looking at bullish fair value gaps, you're going to be looking at the lowest portion or the lower half of it. What do I mean by that? Well, if you look at the price action over here, price drops down and comes right back up. Then it opens here, trades down halfway, and comes back up. And then the next candle, it opens, trades down, and closes. And the next candle does what it does here. It takes 3 candles in this time frame to make one 15-minute candlestick. So when you're looking at price, what you're focusing on is the upper half when it's a bearish fair value gap. So we're splitting it in half. This shaded area over here on the 5-minute chart is this shaded area over here on the 1-minute chart. This back and forth price action in the upper half of that is a balanced price range. What makes it balanced? The fact that we're in the upper half of a bearish fair value gap. So the upper half, if you see back and forth price delivery, that is not inefficient. This drop down in here from the middle of the shaded area up here, all this single candlestick right there, that is not an inefficient price delivery. It's extremely efficient. Why? Because the first candle dropped down into it here, and then we went back up over top of that same range in here. Went outside of that level that we're identifying as the high of the 15-minute SIBI, and then it returns back inside the range and stops halfway again, and then rallies once more. And the bodies are respecting the upper half high of that SIBI. Then it drops aggressively lower. Now, if you're not looking at price the way I'm showing you here, which is why you got a lot of these mentors out there that are trying to teach my stuff, SMC concepts, and they don't ever mention me, because if they do, they have no presence anymore. They don't have any voice, because they won't go to them and pay them. They'll be just right here at the YouTube channel where it's authors teaching it. They'll call this a fair value gap, and they'll look for this to try to close in and fill the numbers, and that won't happen here. It will not happen. Why? Because it's efficiently delivered back and forth price action, and then it trades down into the lower half and then validates it as a fair value gap. So once the fair value gap is there on a 15-minute time frame or any time frame, you drop down to the lower time frames and you study what price actually did in the upper half when it's a bearish fair value gap, or you study the lower half when it's a bullish fair value gap on a lower time frame chart. When price goes back and forth in the upper half, it becomes balanced. There's no need for price to come back up in this shaded area over here when it starts to return back inside of it. Now watch. We're going to take a huge leap. When do fair value gaps form? Inside the quarters. Now, that's not quarters theory. Okay, I already know some of you guys are running around right now. You can't wait to go on to X and go on to Instagram and say, this is what Michael's been using all along. It's quarters theory. Wrong. What I'm talking about is time. So if we were looking at the time of 10 o'clock in the morning Eastern Standard Time, from 10 o'clock at the top of the hour to 10:15, there's going to be a fair value gap that forms. Every time frame, but whatever time frame you're trading on, you work with that information. And then that means there's 4 potential fair value gaps that form per hour. Now the apt pupil will think about that for a moment and say, wow, there's potentially a scalp every 15 minutes. Yes, that's high frequency trading algorithm. That's high frequency trading algorithmically. It's also knowing that you don't have to take the trade that you just missed and have any regret, because there's going to be another one, just like a bus. Remember I taught how that's a bus route schedule? Every 15 minutes, there's something coming around the bend again. Now, for some of you that just simply want to trade on a daily chart or higher time frames, it won't be like that for you. But for the price action, scenes that I create, we're in these lower time frames because there's a plethora of opportunity, and these opportunities are extremely abundant. So every quarter, so 10 to 10:15, there's a fair value gap forming. 10:15 to 10:30, there's a fair value gap forming. Between 10:30 to 10:45, there's a fair value gap forming. And 10:45 to 11 o'clock, there's a fair value gap forming. On whatever time frame that you see that form, whether it be the 15-minute, the 5-minute, either one of those, you're going to see one of these fair value gaps form every single 15-minute time frame. When you have the draw on liquidity, it will be there. Now, if the market's going to be range bound, it might not create that, because why? We're going to be in a high resistance liquidity run conditions. That means there won't be fair value gaps forming, which is the reason why I teach the number one premise is, are we in low resistance or high resistance liquidity run conditions? If you're seeing fair value gaps not materialize, then you're in high resistance. Sit and wait. Wait for what? Wait until the next 15 minutes. And then if it's the same way there, wait 15 minutes longer. And you do that all the way until you get to the end of the session. If the entire session was high resistance, you did nothing and you took no trade. Come back the following afternoon or next trading day. Now, what can you use this information when it's a balanced price range? Well, it identifies what? The lower half as what? An imbalanced price range. Why is it imbalanced? Because it leaves the upper half here and it only sells off. There's no up candle to the midpoint of it. That's sell side imbalance, buy side inefficiency, meaning that it needs to offer price back up to the midpoint. That's what you'd be waiting for. That's what the algorithm is doing. Buying pressure is not bringing it up and stopping it dead in its tracks halfway. That's algorithmic price delivery. It's going to offer that price over a continuous delivery, higher, 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 no matter how many people come in wanting to short, no matter how many people are reluctant to buy, it does not matter. Okay? So when you're looking at depth of market, level 2, footprint, all these things, the market doesn't care. It doesn't care about the number of contracts. It does not care. It doesn't care. Now, the number of contracts is the life's blood of what you can get filled on trades. But the delivery mechanism has absolutely no care, no concern for the actual number of trades being booked, which is why I'm trying to tell you, and I've been telling you since I started teaching it, that this algorithm that exists is a price engine. It will deliver right to these specific PD arrays and their consequent encroachment. There's no way, there's absolutely no way that buying and selling pressure would deliver that. It would be random distribution. There would be all kinds of different highs and lows forming, but they're stopping dead in its tracks where I tell you it stops. That is authorship. That's something that you can't go around. You can't hide from that. You can't chase it down and say, I'm going to beat it into submission and say it's something else. It's not anything but algorithmic price delivery. That means the price engine will offer that midpoint consequent encroachment because that's exactly what it's scripted and designed to do. So the market trades up in there and then efficiently delivers buy side. So now there is no inefficiency for buy side delivery. So we had sell side imbalance, buy side inefficiency. The portion that's inefficient on buy side is the lower half. Why? Because we only had a single pass with this candle's halfway point right here, where the shades of the boxes change color. From that point down to the low of that shaded area, or specifically this candlestick's high, it's only offered sell side delivery. That means movement lower. So because the market is algorithmic, because it's controlled, because it's rigged, and you should be thankful that it is, because if it wasn't rigged, I would not be able to do these things. I would not be able to tell you it's going to stop here, turn around, go at this candle, stop here, go higher, and I certainly wouldn't be able to execute on it, right? But you keep seeing it. Now my students are learning how to do it too. Well, delivering price up to the halfway point here satisfies the coding in that algorithm. It need not go any higher. So now we're going to take a huge leap in understanding, okay? This is the inefficiency that really matters. in that 15-minute time frame fair value gap. It's also this portion here on a 5-minute fair value gap. But you won't be confused by looking at the 15-minute time frame fair value gap and think it has to close in the upper half of it, because it doesn't. That becomes a balanced price range. So using the price delivery continuum theory, which is working from higher time frame, lower, lower, higher time frame, lower, lower. You're constantly cycling through. Every time a new 15-minute candlestick forms or begins, you refer back to that 15-minute candlestick chart and see where you're at. What inefficiencies are there? Did it form one? Did it close in or deliver the numbers? Okay. If it didn't fill the numbers on the inefficiency, in other words, close in and overlap the inefficiency of a fair value gap, then you're constantly waiting for that information to be delivered in price action. But if price is showing things like we're showing here, where it's working the upper half and it's a bearish fair value gap, you can anticipate that that 5-minute portion here is the real fair value gap, because we've done the work of looking at actual price delivery. We don't need to look at orders. We don't need to know how many contracts were traded at, because that doesn't matter. The algorithm doesn't see your stop. It doesn't see how many contracts were traded at a particular range of price action. It doesn't refer to that, folks. It can't. That's too much of an effort to code that. The only thing it refers back to is number one, time, and then it works on the open, high, low, and close. It doesn't use Fibonacci. It doesn't use Ichimoku candlesticks. It doesn't use, whatever else, candy bar nickname they want to give their stuff. It only uses the open, high, low, and close on a time-based delivery, okay? So let's take a huge leap forward from this. This portion, it's not gonna close in. It's not gonna overlap that portion. It's not going to fill the numbers on the upper half of that bearish fair value gap. Now, if it's not going to do that, folks, on a 15-minute time frame, what does it make it? What can you do with that information? Number one, it helps you with stop placement. Your stop can be in the upper quadrant of that known area right there, because that's not likely to fill. A more conservative approach would be put your stop loss just above that shaded area here. Upper quadrant is fine. Consequent encroachment, I wouldn't do that. It's a little too close and the spread might get you, because we allow the wicks to do damage. But if we were to get stopped out using this information, as long as we traded back up into the lower half of this portion, it should not offer the filling of the numbers. I mean, the upper half of that 15-minute time frame's fair value gap, I would re-enter the short and place the stop loss again into the upper quadrant of it, or just above the high, with half the number of contracts that I just took. Okay, so now we've covered stop loss placement. We understand how to properly handle inefficiencies when they're bullish or bearish. I told you when they form. Every single 15-minute time